Okay, so I'm going to discuss. I will try to make the video short, and I'm going to discuss about the approach to to technical to financial market. Okay, so basically there are two ways you can look into the financial market. We have the fundamental analysis, and then we have the technical analysis. Okay, so basically any forex traders can go into to analyze the financial market by looking at the fundamentals, okay, and the technicals. I'm going to tell you the difference between the two very soon. Okay, so that's the basically two ways you can. Okay, so the fundamentals, like we said, that what moves the price in financial market. Okay, we have the economic factors, we have the political factors, and then we have the environmental factors. Okay, so the previous classes we discussed about that. Okay, so now the fundamental is when you consider the economic factors, you consider the political factors, you consider the environmental factors. Like for example, now in Nigeria, there's election going on. So the election now definitely is one of those things to consider that will definitely affect either naira is going to rise or fall. I think we understand that already. Okay, so that's fundamental. When you are considering these three things, there are websites that tells you when the news is going to come up. So all those stuff comes in form of news. Okay, so the website will tell you where the news come up. So you try to analyze the data from the news, then you make your decisions. But and the next one is now fundamental technical analysis. Though it is good for every technical analyst to also look into the fundamental analysis, okay? But most of the time, what we focus on more is the technical analysis. Why? Because technical analysis brings about all the past data, the present data, and the likely. Then you can be able to predict the future with what you have already. The technical analysis tells you where the market was coming from. It tells you where the market is now, and then what price can do at any time. So there are different approaches to approach there are different approach to technical analysis. Okay, there are different approach to technical analysis. We have the price action. Okay, so price action basically is the same thing as technical analysis, but let us take price action. Price action basically is when you are looking at some patterns and you study the candlestick momentum. That is basically price action is basically about candlestick momentum. Okay, and we talk about and today we will talk about candlestick definitely. Okay, so now for the price action, we have pure price action. That is analyzing the price yourself, looking at the chart, trying to get the data that the chart is providing, and then you'll be able to interpret it and make your decisions through that. The second one is price action plus indicator, partial price action. Okay, price action plus indicator, it means that there are some indicators that have been built, okay, by algorithms and mathematical calculations. Okay, those mathematical calculations brings about the what's it called, will analyze the market for you, analyze price for you, and then you read that indicator to be able to make your decisions. But I will say that pure price action is better, because what the indicator knows, that what the indicator has been programmed to do, you know how to do it yourself. Okay, instead of you relying on the indicator read the market and then you start reading the indicator. So it's just too stressful, and sometimes indicator, most of the times, not even sometimes, most of the times indicators lags and they give false signals. But you, by to right training and mentorship, you'll be able to know what the market is doing itself. So another approach to technical analysis, we have the harmonic patterns. That's when we talk about BAT. It's also popular outside there, but myself, I took study about it, but I don't use harmonic patterns as at the time of this video. Okay, we have SMC, smart money concept. But smart money concept basically wants the idea behind smart money concept is to study how the institutional traders, how the big funds traders, how they trade the financial market. Okay, so it's basically to minimize your losses. Is to minimize your losses and to have high winning, to have more risk to ratio reward. Okay, so then we have the Wyckoff method. The Wyckoff method also is by looking at when the market, the acceleration period, the accumulation period, the distributions, and those of and all those stuffs. Okay, it also deals with patterns, and the father of them all is Elliot Wave theory. So out of these 5 systems of analyzing technical analysis, I basically use 3 out of them. Okay, I use price action, pure price action basically. I use SMC, okay, just to fine tune my trade, okay, based on some techniques on SMC. And I also trade Elliott Wave theory. Okay, I also trade Elliott Wave theory. Okay, so that's what you need to know. So what we are starting our lesson on today is candlestick patterns. And candlestick patterns basically is a foundation, is what all price action is built upon. Okay, so during the live class, I'm just doing this recorded video so that I'll be able to explain to you what we discussed basically. Okay, during the class, during the live class, I told you that Omar, who happens to be a rice trader in Japan, the full name of that particular candlestick is Japanese candlestick. That's the full meaning. That's the full, yes, the full meaning, and it was by Omar. Okay, so what he did was that he wants to try to get where the open of the price of rice, okay, opens for the day, and where the price of uh rice close for the day. We are going to get into that very soon. So that was his major concept, and by that it came out with a very bigger concept than that of only candlestick. And candlestick is very popular among Japans and also in the US, okay, among the Western people too. And that is the form of the most used form of analyzing the market in the recent world also. Okay, so another thing you should also consider is that um the candlestick, okay, Omar happens to be is regarded as the most successful trader in the world. Okay, is regarded the most successful trader in the world, and if it's net what he gained from the system he created, okay, if you are to calculate to this present world, is nothing less than around $10 billion. Okay, so let's go to the anatomy of candlestick. The anatomy of candlestick, we look at what candlestick itself entails. So I'm still going to go back to the idea of Omar before now trying to look at it in the present world. Okay, so bullish candlestick, we will major on bullish candlestick today. Okay, and the next class, which is tonight, okay, we have the class tonight. We'll be looking at bearish candlestick. And whenever you hear bullish in the forex market, bullish means the buyers market. It means that the buyers are more stronger. That's what basically it means. And traditionally, you use the you use the yeah, you use white color to indicate that. Okay, and the bearish, of course, black color. But nowadays we now use green color for the bulls, okay, for the buyers, and red color for the bears. Okay, so whenever you hear bullish market, it means that the strongest the buyers are stronger in that market. Okay, so having said that, let's move to another to the part of a candlestick. We have basically two things to look at in a candlestick. Two things, okay, to look at in a candlestick. That's the body and the wick. The body shows the strength, okay, of the buyers. In the case of bullish candlestick now, it shows the strength of the buyers. Okay, it shows the strength of the buyers. That is what the bullish candlesticks do. So okay, so that is basically the work of the bullish candlestick. It shows the strength of the buyers. Okay, and why the wicks? You can call them wicks, tail. What do we call them again? Wicks, tail, shadow. Okay, that's the 3 things you can call them. Let me call this is the body. You can see that is bigger. That's the body. That's the body of the candle. Okay, then we have the wicks of the candle also. The wicks of the candle, you can see one wick up there and another wick down there. Okay, so that's a wick. You can call this wicks. You can call this shadow, and we can also call it an tail. You can call it tail. Okay, so we can call it tail. So that's this. Okay, so the same thing here also, the same thing down there. So basically from that word week, okay, it basically tells us that that is where initially to that level sellers were there in, okay, sellers strength, they are sellers presence over there. But even though as the sellers were there, the buyers took over. That's basically what it means whenever you see the wicks. Okay, it shows the quantity in that particular time frame. Time frame is that period of time, okay, that we have. Okay, the sellers were there, but before the close of that candlestick, the buyers, this is the two parts of the candlestick. We have the body, we can have upper, this is here we have upper shadow. Okay, here we have upper shadow. Upper shadow or upper wick. Then we have the other one to be the down shadow, or anything wick or tail you want to call it. Okay, so let's move to the informations that candlestick carries. Okay, I'm going to do a quick explanation of the idea behind what Omar was trying to do before it came about this. Okay, so like I said earlier, what Omar was trying to do is to note the beginning and the open of the price of what, of rice, and the close of it. Okay, so look at it now. So let's assume that this is where the rice opens for the day. At this particular level of price is where the rice open for the day. Then buyers came into the market, into the rice market, they push different activities was going on. Okay, different activities. We had a lot of activities. So all those things happens in the forex market. Then it moves below this level. It came in again. Okay, move up within that particular day, and then it enters again and close around this level. It enters and close around this level. So let me quickly explain the idea behind this. The idea behind this is that this is where that market opens. Okay, that particular price opens. This is where it opens. Okay, so this is where it opens. Sorry for that. Opens. Okay, and here it's close. This is no, we said that's not the close. Okay, so I said it closes around this level. So let me use something else to mark that level. This is the level at which it's close. Okay, so we can see this level. So basically this information I just use as with line. This is a line chart. Okay, so the first two information that we can see here is that this market opens here. Okay, it opens around this level and it closes around this level. Okay, so another thing is that what is the total range? The range, it also covers the range of that particular price. And what is the range? Low of that, of the price for the day, the low for the price of the day. Okay, that's the low for the price for the day. And here we have what, here to be the high for the price of the day, high for the price of the day. Okay, so here we have the high for the price of the day. Okay, so all this stuff still happens within one candlestick. I'm going to show you the candlestick now, how to use a candlestick to determine this. Okay, so now let us look at it. We said the candlestick opens here, it opens here, and then it closes here. Okay, that is big strength that we have here. Then we also have, at a particular time when the market started, it moves up, moves to this level, it came down, moves to this level, then it came down to form a low here. Okay, by the buyers, this level here happens to be the strength of the buyers pushing it downward to this level here. The buyers push it downward to this level here. Okay, remember that. Then after that, it moves up again with a strong rally up to this high to form high here. Okay, I don't want something that is too. Let me put it there. To form high here. Good. To form high here. Then sellers came in again to push it down, and the price closes around here. So, and then this is how we came about the candlestick. So that means within this region, okay, in the future, within the regions, we look at that the strength of the sellers is very much around this level, okay, and then this is what we study, okay, to look at the strength and the momentum of a candlestick. Okay, so all this you must understand it very well. If you have any question, you can always ask me, explain better. Okay, so that's basically the informations. Then here, what do we have on this candlestick here? We definitely have, so for a bullish candlestick, this is the open. As far as the market closes above the open, it means that the buyers are having what? More strength. Okay, and here this is what? The close. You can see that this is bullish. This is basically bullish. Okay, and I said traditionally, what we can use what? We can use white candle for bullish. Okay, and presently most platforms will have um bullish to be green. So I'm going to change this to green to show you what you are going to have in your on your chart. So this is basically something like this that you're going to have. So we'll continue from this and explain better tonight. Okay, so if there's any question, this is just a recap of what we talked about. If there's any question, you can always ask.